Very interesting, Jack, today. The commentary from Ken Griffin, the chief executive of Citadel, who was at the UBS Financial Services Conference, and said of the proposed tariffs from the president, quote, "From my vantage point, the bombastic rhetoric, the damage has already been done, and it's a huge mistake to resort to this form of rhetoric when you're trying to drive a bargain because it's like imprints. It tears into the minds of CEOs, policymakers. We can't depend upon America as our trading partner. Regrettably, the other side of the story is the uncertainty and chaos created by the pair of dynamics between us and our allies. Is it an impediment to growth? It makes it difficult for multinationals." I mean, there's one of the world's greatest investors saying that the rhetoric's not good, the damage has already been done, and there's chaos as a result. Is that a problem for markets or no?
I think to some extent it can be said that any sort of uncertainty from a policy perspective is going to flow through into uncertainty at the executive level in any sort of business, right? And there may be a hesitation to invest there. The bigger problem for me, though, Scott, is how uncertainty around policy compounds with the uncertainty that we already have in data, right? This idea that Anastasia just brought up that maybe tomorrow's CPI print could be a little bit warmer. And uncertainty in data plus uncertainty in policy translates into even more uncertainty in interest rates. It has a compounding effect there. And that volatility that we've been seeing in interest rates is likely only going to pick up over the course of the year, which then translates into choppy markets, stocks, and bonds. So that's where I think the issue really is just all that craziness.
However, I would say that, yes, obviously, I think investors would agree with most of that. But we do have certainty in the place that you could make an argument matters more than anything else. Earnings, right? Earnings have been really good. Otherwise, the market wouldn't look like it does. Yeah. It wouldn't look like it did yesterday when you had the reports of tariffs coming by the end of the day, and the market was up. It's able to look past all of that because earnings have delivered.
That's right. I mean, we've all talked about the choppiness and the volatility. If you look at the daily swings, they have been amplified so far this year. But, Scott, if you look at the market returns, the S&P is up 3.14%. The NASDAQ is ahead. The AI power theme is, by the way, up 10% despite of what happened with DeepSeek. And I think it's spot on. It has to do with the fact that, yes, there are headwinds, but I think they're incremental headwinds, and they're not going to derail the entire earnings story. And so consensus is looking for a 13% earnings number from the S&P this year, another 13% growth next year as well. And let's say the dollar does appreciate and we shave off 2 or 3 percentage points of earnings growth. Let's say some of the tariffs do go into effect, or maybe there's the uncertainty discount. Maybe that shaves off another, 1% or 2, but it doesn't derail that entire 13% earnings growth story. And I think that's why investors keep coming back to stocks. And by the way, they really keep coming back to artificial intelligence that continues to be the anchor for the market.
I mean, this is why you argue, Jack, it's still a risk-on environment. Certainly. No one's naive to the risks that are out there, but it is risk-on, as you say, with a healthy dose of caution. Yeah. Because of tariffs and because of other things and because of the potential backup in rates, a slower Fed than even we think now.
It is partially tariffs, but that's certainly not the big story. To me, what we're looking for in 2025 is this broadening out of earnings growth participation. It's something you've seen happen already in the fourth quarter. But a lot hinges on the macro data for that broadening out of the earnings story to actually take place, right? This narrative was that, hey, rates are coming down a whole lot and inflation's going to come down a whole lot and wage growth's going to come down a whole lot because the labor market's going to cool out. And we don't actually know if these things are going to happen, at least on the margin. I like the way you put that, Anastasia. It's marginal issue. So, yes, things are better now than they were a couple of years ago, but are they as good as we thought they were going to be a couple of years ago? That's where the question is. And so I still think you are going to have some winners and losers this year in the face of a lot of uncertainty, policy or otherwise.
The loser so far this year has been tech, right? It's the worst performing of the sectors out of the S&P. Whereas you have things like financials, which are up more than 6%. Healthcare is up better than 6%. Yeah. Now, comm services is up better than that. Thank you, Meta, which is on this astounding and unprecedented run for any of these stocks. But what about areas other than tech? Time to really lean in?
You know what financials and healthcare have in common? They have the domestic focus. And if you think about the stocks that have really been outperforming in the last couple of weeks, especially as we've had this, back and forth tariff ping pong, it's stocks that don't have a whole lot of cost of goods sold that are importing from outside of the United States. So think financials, think healthcare. And it's also stocks that are not selling a whole lot internationally. So they're not subject to those retaliatory tariffs. And so that's why tech, some parts of tech, non-AI parts of tech have been lagging. So So yes, I do think, Scott, that it is time to focus and tilt the core of the portfolio to domestic sectors of the economy. It's financials, it's healthcare. By the way, it's quite inexpensive relative to the S&P, and it's also utilities. So I think that's what the core should be. But again, I come back to artificial intelligence story. I think the Trump administration is going to continue to support the investment. And you mentioned Meta. The biggest read-through for me from Meta and the likes of Meta and Amazon is they continue to invest in artificial intelligence capex. So yes, if you look at the SMH, ETF, the semiconductor ETF, has not gone anywhere. But if you look at AI semis, if you look at AI software, it's up 18% for the year. So even in tech, you can find spots.
I'll give you the last word. I mean, financials, healthcare, where you want to lean in. You totally agree.
I do agree, absolutely. I mean, you have that domestic focus, which is great. You also have some pretty interesting idiosyncratic tailwinds. You got a lot of excitement in healthcare around in American innovation and GLP-1 drugs. In the financial services space, you have this prospect of deregulation alongside increased IPO activity, M&A activity, better markets, all of these things supportive of earnings, in addition to macro tailwinds, in addition to that domestic focus. It's a good place to be.
All right, good stuff.